Roth IRA versus traditional IRA. Investing is an effective way to put your money to work and potentially build wealth. Smart investing may allow your money to outpace inflation and increase in value over time. The greater growth potential of investing is primarily due to the power of compound interest and the risk-return tradeoff. Moreover, investing is one of the best ways to accomplish one's financial goals and provides buffer for unforeseen expenses that may arise in the future. The income resulting from investing can come in many forms, including financial profit, interest earnings, or appreciation of asset value. Investing is not just a good idea. It is essential to building wealth and beating inflation, as stated earlier. If you are not investing, your saving will slowly lose value due to inflation. Investing is riskier than just stashing your money in the bank, but it can pay off handsomely as well. One of the most important benefits of investing in an IRA is the ability to grow your money tax deferred. With IRAs, you typically won't have to pay current income tax on any investment gains until those earnings are withdrawn. The money that will otherwise go to pay taxes can stay in your account and continue to compound, giving you the opportunity to accumulate more wealth over time. Some IRAs even allow investors the ability to take tax-free money or tax-free income at retirement. Here are two investment retirement accounts most successful investors are familiar with. A traditional IRA or traditional investment retirement account is a type of individual retirement account that allows your earnings to grow tax deferred. However, you get to pay taxes on your investment gains when you make withdrawals while in retirement. The IRS typically doesn't assess any capital gains or dividend income taxes until the beneficiary makes a withdrawal. Taxpayers are allowed to deposit 100% of any income up to a specified maximum dollar amount, as at times income thresholds apply. If not all, most contributions to a traditional IRA may be tax deductible depending on the contributor's income, tax filing status, and other factors. Anyone or entities wishing to open a traditional IRA may do so through either their brokers, including online brokers and robo-advisors, or financial advisors. Keepers, including but not limited to commercial banks and retail brokers, can open traditional IRAs and place the funds into different avenues according to the account holder's instructions and based on the options available. As stated earlier, in most cases, all contributions made to traditional IRAs are tax deductible. For example, if someone deposits $6,000 into their IRA, they can claim that amount as a deduction on their income tax return, and the IRS or Internal Revenue Services will not apply income tax to those earnings. However, when that person withdraws money from the account during retirement, the withdrawals will be taxed at their ordinary tax rate. When you receive distributions from a traditional IRA, the IRS treats that money as ordinary income and subjects it to income tax. Account holders can take distributions as early as the age of 59 and a half. Starting after the age of 72, account holders must take required minimum distributions, RMD, from their traditional IRAs. Note, as set by the Secure Act, which became law in December 2019, the age 72 threshold applies from 2020 onwards. The old RMD threshold of 70 and a half still applies if you turn that age before December 31st, 2019. If one wishes to remove some funds before having retired, the person will incur a 10% penalty fee of the amount withdrawn and taxes at standard income tax rates. However, certain exceptions may help with waiving those fees. Some examples include you plan to use the distribution towards the purchase or rebuilding of a first home for yourself or a qualified family member, limited of course to $10,000 per lifetime. You become disabled before the distribution occurs. Your beneficiary receives the assets after your death. You use the assets for unreimbursed medical expenses. Your distribution is part of a SEPP program, substantially equal periodic payments. A Roth IRA. A Roth IRA is an individual retirement account that offers tax-free growth and tax-free withdrawals in retirement, provided that certain conditions are satisfied. Roth IRAs are usually funded with after-tax dollars, thus making the contributions non-tax deductible. But once you start withdrawing the funds, the money is tax-free. Roth IRAs rules state that as long as your account has been operative for up to 5 years and you have reached the age of 59 years and a half or older, you can withdraw money at any time and you won't owe any federal taxes. Roth IRAs can be funded through several sources: regular contributions, spousal IRA contributions, transfers, rollover contributions, conversions, and etc. All regular Roth IRA contributions must be made in cash, which also includes checks. They can't be in form of securities or assets. However, a variety of investment options exist within a Roth IRA. Once the funds are contributed, including mutual funds, stocks, bonds, ETFs, CDs, and money market funds. The IRS limits how much can be deposited in any type of IRA, adjusting the amount and also adjusting the amounts periodically. The contribution limit is the same for traditional and Roth IRA. Similar to other qualified retirement plan accounts, the money invested within the Roth IRA grows tax-free. However, a Roth is less restrictive than other accounts in several ways. Contributions can continue to be made at any age, as long as the account holder has earned income. The account holder can maintain the Roth IRA indefinitely. There is no required minimum distribution or RMD during their lifetime, as there is with a 401k, and a traditional IRA. A Roth IRA must be established with an institution that has received IRS approval to offer IRAs. These include banks, brokerage companies, federally insured credit unions, and savings and loan associations. Generally, people open IRAs with brokers. A Roth IRA can be established at any time. However, contributions for a tax year must be made by the IRA owner's tax filing deadline, which is generally April 15th of the following year. Tax filing extensions do not apply. There are two basic documents that must be provided to the IRA owner when an IRA is established: the IRA disclosure statement and the IRA adoption agreement and plan document. These provide an explanation of the rules and regulations under which the Roth IRA must operate and establish an agreement between the IRA owner and the IRA custodians or trustees. In conclusion, the biggest difference between a Roth IRA and a traditional IRA is how and when you get a tax break. The tax advantage of a traditional IRA is that your contributions are tax deductible in the year that they are made, whereas the tax advantage of a Roth IRA is that your withdrawals in retirement are not taxed. The end. Thank you.